Recently, there's been a number of attack pieces and negative articles being published online about some of my favorite high-yield dividend stocks. And although some of them do present a good argument or two, in this video I'd like to take a closer look at some of these articles and give my opinions as to why I disagree with them. Despite what these articles say, I'm still choosing to hold on to these positions in my portfolio. Even in situations where an author might make a good point or suggest that an alternative investment is superior, I don't believe their arguments are strong enough. But let me know at the end of this video if you happen to agree with any of these articles or with any of the arguments being made in them. The first stock that's been receiving criticism lately is Main Street Capital. I just talked about this stock last week and how Main Street Capital just launched a second publicly traded BDC recently. But there's been so much to like about this stock with its monthly distributions and its excellent streak of uninterrupted payouts with regular increases and special dividends. But lately there's been some criticism around this company and their stock's recent performance, and some suggesting that investors should unload shares of it. An article published on Seeking Alpha titled Main Street Capital, 2 Reasons to Sell Right Now lays out 2 main arguments for dumping Main Street. The first reason the author gives is that their stock is currently trading at a huge premium. This argument is true, and I've discussed this numerous times over the past couple years actually. To determine if a BDC is overvalued or undervalued, analysts will compare the share price of it to its NAV per share, or sometimes referred to as its book value per share. With their last NAV per share being $31.65, Main Street stock is currently trading at a 92% premium. This makes this stock the most overvalued in the entire BDC sector. But this is where it gets really tricky, because you can't value this stock based off this commonly used metric alone. If we only valued this stock comparing it to its NAV per share, then the last time Main Street was trading even close to fair value, with the exception of the COVID plunge, was nearly a decade ago. And if you had invested in Main Street Capital 10 years ago, again despite it being overvalued, your returns from this stock would have been incredible. The reason why you can't value this stock like all other BDCs is because they pursue a different strategy compared to their peers, which involves holding more equity positions. Main Street has been able to grow significantly faster because of that, and investors have been willing to pay a higher premium for all this growth. This explains why it's currently at a massive premium right now. But does this mean that we should sell Main Street Capital in exchange for something else? If you want a stable monthly dividend, then I would argue no, you shouldn't. At some point, I don't know when, but I do believe Main Street will fall in share price by a pretty good amount and come to a more reasonable valuation. But why try and time the market, especially if you are currently living off dividends? If you want to rebalance your portfolio and sell shares for that reason, then I think now might be a good time to consider that. I would say just stick with it and don't try to sell out trying to time the market. The second argument is that non-accruals for this company are on the rise. Non-accruals are the percentage of their investments that aren't performing up to expectations. What this means is the companies that they've lent money to aren't able to pay them interest on their debt that they've taken out from Main Street. According to this article, Main's non-accrual rate reached 1.4% and 3.9% of fair value and cost respectively. Fortunately, according to their most recent results that came out after this article was written, non-accruals went down for this company. Also, the BDC long-term average has been 3.8% at cost, so Main Street is right around average when it comes to this metric. Definitely not a good reason to be overwhelmingly concerned about it. Finally, according to their most recent results, Main's dividend coverage is still at 146%. They also announced a special dividend, something they likely would not have done if their distributions were at risk. So overall, I don't see a good reason to just dump shares of Main Street Capital. It's clear that their dividend currently isn't at risk, but it is also clear that now isn't exactly a good time to buy, at least not heavily. But based upon everything that we just looked at, I don't see any reason to believe that they're in any kind of trouble. The next article is about the NEOS S&P 500 High Income ETF, and the title is, SPYI, is the 11.9% dividend yield secure? We think not. The author does a comparison between the NEOS fund and several other ETFs that follow a very similar, although not exact strategy. When compared from a total return perspective, the author does note that SPYI has been the better performer when compared to other funds like JEPI and Global X's XYLD. SPYI also offers the better yield when compared to these other funds. However, they recommend investors buy something completely different called the Eaton Vance Enhanced Equity Income Fund, ticker EOI, instead. This is another options-based fund that writes covered calls, but it appears it only does so on 50% of its portfolio. So as a result, what you'll get is more share price gains, but a much lower yield. Eaton Vance has also been able to deliver a much sturdier dividend from month to month. If we compare this closed-end fund to a typical covered call fund like SPYI, you'll see the option strategy results in a different dividend amount each and every month. Now, ultimately, EOI is not a bad investment. In fact, it's actually done really well, and it could be considered a safer alternative to the more normal CC funds by Neos, Global X, Round Hill, and the likes. But this strategy does come with a couple of major downsides. The first major drawback is a much lower dividend yield. SPYI has consistently offered a yield of around 12% given the way it generates income. EOI, on the other hand, only yields 7.96%, much lower compared to the Neos funds as of the making of this video. Second, EOI is also a closed-end fund and not an ETF, and these typically come with much higher expense ratios, which is the case in this situation as well. SPYI's expense ratio is 0.68%, whereas the expense ratio for the Eaton Vance fund is 1.1%. That makes it significantly more expensive than the Neos fund. Now look, I've been saying for years that when it comes to expense ratios, that paying a higher price for something is fine if an investment functions in a way that you want it to. I know that not everybody agrees with my opinions on expense ratios, so if you don't, then SPYI is likely going to be the better choice for you. I do hold closed-end funds in my portfolio with high expense ratios like this one. But my main point is, if you're looking at an investment that offers high income and one is charging significantly more than the other, then I'm likely going to consider the cheaper one. There was another argument that was made, which is, according to this author, this ETF's distributions will go down as the S&P 500 index goes down, which is also what the title was referencing. But the amount of dividends paid by covered call funds largely has to do with the amount of market volatility in whatever index they follow. The more volatility there is in the market, then the more that influences the monthly distributions. But the amount of dividends paid by EOI also depends on market volatility, just to a lesser extent. Throughout its history, it's had to cut its dividend a couple times, so it's not invincible to that obviously. Again, EOI is not a bad investment. If someone prefers it over SPYI, then I don't see an issue with that. Other than more share price growth, it doesn't really offer much else that could be considered superior. People who like SPYI like it for its income and not share price appreciation. If that was their main goal, then they'd focus on something else. So that's going to be our look at a couple of articles criticizing some of my favorite high-income positions. I wasn't really able to find anything really negative about most of my holdings, especially my REITs. It's a sector that's been flourishing despite how the market's been performing over the past couple weeks. A lot of people are running to these safe dividend investments as share prices have been really volatile. Let me know your thoughts and if you think they made any convincing enough arguments to sell out of these positions or trade them for something similar. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.